Hi, this is Chris Buteau with Capstone Home Loans, and I'm coming to you with my Mortgage Minute on behalf of the Danielle Goheen team. And today I want to talk to you about locking an interest rate or choosing an interest rate. Generally, it's axiomatic that you'd want to take a lower interest rate versus a higher interest rate. But I think it's a little more nuanced than that, and it's good to consider what the implications are of those different interest rates. Most people are familiar with the concept of paying points. On any given day, interest rates are priced based upon mortgage-backed securities, which are traded in the financial markets. And in theory, there's a par rate in which the lender's not charging you extra to take that rate. It's just the market rate. Nor are they incentivizing you by subsidizing your closing costs to take a higher rate. And so you can choose a par rate. Or you might think, I want a lower interest rate and I'm willing to pay a little bit more upfront cost in order to get a permanent long-term lower interest rate. And that might be a good strategy, but it might not be as well. And the things you have to think about is generally the break-even point on paying points isn't coincidental, it isn't accidental. Just like extended car warranties are priced in such a way so that the car finance companies make money over the pool of people who buy them, paying points are priced in such a way that the lenders are typically going to make money. They're based upon the average life of a loan, and so you can be paying money up front, and the break-even point is typically going to be about the average life of a loan, which, depending on what market you're in, can be somewhere around 5 years or so. And so if you were paying, let's say, an extra $3,000 in points because you think over time you're going to benefit from that, but if it takes you 5 years to break even, and the average life of a loan is 5 years, then you're betting $3,000 up front that you're going to be there at least that 5-year period. And then if you are there for a full 5-year period, you haven't hit the jackpot, then you start to eke out the benefit of that lower interest rate you bought with each additional month that you're in that beyond the average life of a loan. So I'm not suggesting that it's not a good idea to pay points, but I think it's wise to consider not only what the break-even period is, what your likelihood is to be there significantly longer than that break-even period, but also what is the relative value of that lower monthly payment versus that additional cash that you could have if you took a higher rate. That's the other thing to consider is, if you're very disciplined with your money and that lower interest rate nets you, let's say, a lower payment by $35 a month or $50 a month. Is that $50 a month going to change your life? Are you going to do something meaningful with that? Or would you be better off with the extra $3,000 when you buy a new house because you have certain costs and things? So anyway, just some things to think about. Thanks so much. This is Chris Buteau on behalf of the Danielle Goheen team with your Mortgage Minute. Thank you.